Hey guys, welcome to the channel. Today we're going to talk about commodities. So, what are commodities? Basically, commodities are things that we need, humans, to sustain our life and our way of living. Commodities can come from the earth, like precious metals that we use for electricity, money, and buildings, to things that we eat, like corn, beef, orange juice, etc. Commodities as an asset class have averaged about 8% long term returns. Compare that with the average inflation rate of 3%, and on average, commodities beat inflation by about 5%. Let's look at the types of commodities. So we have what's called hard commodities, such as gold, silver, oil, etc. These are commodities that can be stored for long periods of time, and they won't spoil on you. Soft commodities are things like orange juice, sugar, coffee, etc. These are the types of commodities that you cannot store for long periods of time. So, who invests in commodities? So, the commodities markets were made so that, for example, ranchers who own cows can sell their beef, farmers who grow oranges can sell their oranges, and they were also made so that all these producers of commodities could lock in fair long term prices for their products. So, producers of commodities are some people that participate in the commodities markets. These people want to lock in prices of commodities to keep their profits steady and predictable. Other people, like you or I, also participate in the commodities markets. We're called speculators because we're betting on the price of certain commodities are either going to go up or they're going to go down. Sometimes people buy commodities like gold and silver as protection against inflation. So, take for example, during 2020 all the way to 2023, prices for many items went up by a lot. I noticed it most when I went to go buy groceries. When prices go up, that means the value of your dollar is going down. So, people buy commodities like gold because these types of commodities tend to start rising in value when we enter periods of high inflation. So, people buy commodities to protect from the dollar losing value and also to speculate that prices of the commodities themselves are going to keep rising. So, how can you make money on commodities? So, some of the ways that you can make money on commodities are through betting that the price is going to go up or down in a certain time period. You can do this through what's called futures contracts, which are contracts that say that the price of this commodity will reach this specific price by this specific time period, whether it be a month, 3 months, or a year, as an example. Futures contracts are not traded in the stock market, they are traded on the futures market. Futures contracts are very similar to option contracts, which is a topic I will cover in another video. They're called futures contracts because you are betting on the future price of a commodity like orange juice, pork bellies, natural gas, a cryptocurrency, etc. Another way to make money on commodities is by owning the companies that produce the commodities. So, an example of this is owning stocks of companies that produce oil or stocks of companies that mine gold or silver out of the earth. Instead of buying the futures contract for coffee, you can just buy the stock of the company that deals in the coffee commodity, right? Like Starbucks, for example. So if those companies keep making money, then the price of those shares of the stock will go up. A third way to invest in commodities is to hold the actual commodity itself. Like you can buy gold bars and put them in your safe. Other commodities such as oil or uranium will be harder to hold physically if not illegal. So it'd be better to just either own the futures contracts or buy stocks of companies in the oil and uranium industry. Let's say the world starts to run out of oil, which many experts think can happen. As oil becomes more and more scarce, the price is going to go up. So who makes more money from this situation? The oil companies do because, they can charge more for the oil. If you own oil companies, well, then your shares of stock will also go up in price. So to stay with the oil example, prices of oil went up as soon as tensions between Russia and Ukraine and Israel and Palestine flared in 2022 and 2023. Chevron stock went up almost 4% the day after Israel and Palestine, and the ETF that holds oil stocks, VDE, also went up over 3%. I'll cover ETFs in a later video. Between 1975 and 1980, gold went up in price an average of 40% per year during a time that stocks rose less than 10%. The 1970s were a decade that saw massive inflation and high unemployment, as well as an oil embargo in which OPEC, those countries that control much of the oil supply, decided to stop sending oil to the United States, causing prices of gasoline to skyrocket and long lines of desperate customers trying to pump gas. Whoever held gold or oil during these times made a lot of money. I personally remember during the COVID-19 pandemic in 2020 when everyone was fighting over toilet paper in the stores. So prices of toilet paper actually skyrocketed as toilet paper started acting like a type of commodity. You would hear stories of going on Amazon and the prices of toilet paper just shot up. So it was a crazy time for sure. All right, let's talk about the pros and cons of commodities. So the pros, one of the pros being diversification. When stocks and bonds are falling, like in 2020 through 2022, certain commodities can be going up in price, like gold or oil or toilet paper. And even through 2024, gold has still been going up in price. Another pro is the supposed inflation protection. When the prices of things are going up fast, it's nice to own commodities that will also go up in price fast, like gold, silver, etc. This doesn't happen to all commodities, so be careful, but in general, this is the thought process behind owning commodities: inflation protection. Some of the cons of commodities are that they can be very volatile, so they swing up and down very fast and very often. Why does that happen? Well, let's say, for example, that demand for oil falls because the economy is slowing down. Well, this makes oil companies lose money because their product is not in high demand. Nobody was driving to the office during the coronavirus pandemic in 2020 to 2021, so oil prices dropped. Let's say a hard winter hits California and they lose a lot of their orange harvest. Well, this would make orange prices go up a lot because of the loss, right? There's less oranges out there being produced, so the price of oranges is going to go up. If someone were to invent an electric car battery that doesn't use lithium, then demand for lithium would fall, and it would fall very fast. If the whole world switched to electric cars soon, what do you think would happen to the demand for oil and gasoline? You guys know aluminum, right? That metal that you use to wrap your leftover food with, and then you throw it away. Well, hundreds of years ago, it was more rare and more expensive than gold or silver. If you don't believe me, look it up. When they discovered a process to separate the aluminum from the clay that it was stuck to in an easy and cheap way, it became plentiful and cheap, causing its price to plummet. Imagine what happened to the aluminum investor back then. Let's say someone found a way to make salt water from the ocean drinkable in a cheap way. What do you think would happen to the price of water? All those water bottles that you buy for $5 at the grocery store. All those bottled water companies, what do you think would happen with them? Coca-Cola I think they make Dasani, the bottled water. They would probably lose a lot of profits if that happened. Because right now there is no cheap way to take the salt out of the ocean water and make it drinkable for billions of people. Otherwise, we would have a near infinite supply of water for us. But as it stands right now, we can only get our water from the freshwater lakes around the world. And this is thought to eventually run out if our population keeps growing. So how risky are commodities? So commodities are riskier than stocks and bonds. Why is that? Because let's say, for example, a piece of gold does not produce anything. It doesn't have earnings like a stock. A piece of gold doesn't pay a dividend or have a management team that can innovate new services or products. It's just a shiny rock that gets its value based on how rare we think it is. These days, the commodity lithium has gone up in price because of its high demand for electric batteries for the cars. But what if someone invents an acceptable alternative, like a solar powered car or saltwater powered car? Or it's discovered that lithium leaks into the car and gives everyone cancer, and the government bans lithium use in cars. It would crash by a lot. So this makes commodities very volatile and subject to fast increases and decreases in price. Commodities are demanded by humans to live, and some commodities are only demanded based on the fact that we think we're going to run out of them. If someone discovered the largest gold mine in the world, then gold wouldn't be so rare anymore, and it would cause the price to drop. When you have so much of something, suddenly it isn't so valuable anymore. This happened to the United States when the government started printing money and giving everyone stimulus checks back in 2021. It caused massive inflation in 2022 that we were still, here in America, we're still battling in 2023 and in 2024. There was just too much money in the economy, and so it wasn't as valuable anymore. So the same thing can happen when new sources of oil or gold are found. The prices drop temporarily while demand catches up with supply. So just to recap here, commodities, among all of the asset classes I've discussed on this channel so far, commodities are the most volatile. They're more volatile than stocks because, like I said, stocks represent capitalism. They represent innovation. They represent the need to produce new products, new ideas. When they don't produce new products, new ideas, those companies go bankrupt, they go away. New companies are on the rise, they take over. Commodities, a piece of gold is a piece of gold. You know, based on its value is based on what we think the value is. Oil is obviously very valuable today, but if someone invents an alternative mode of transportation or a new way to fuel the vehicles, then these commodities won't be in demand as much. So that's how they can be so volatile in that sense. And obviously we have the rest of the asset classes there, bonds being a little bit less risky than stocks and commodities. And at the bottom there we have cash, which is not going to change value. $1, you pull $1 out of your pocket, it's still going to be worth $1. So thank you guys for joining me in this video. In the next one, we're going to go ahead and talk about cryptocurrency. So join me there.